Before starting video, please subscribe to our channel. Basics of accounting. Accounting is the process of recording, summarizing, analyzing, and reporting financial transactions of a business or an individual. It helps in decision-making, compliance with legal requirements, and evaluating financial performance. Fundamental accounting concepts. Business entity concept. A business is separate from its owner. Going concern concept. The business will continue to operate in the foreseeable future. Money measurement concept. Only financial transactions are recorded. Dual aspect concept. Every transaction has two effects, debit and credit. Accrual concept. Income and expenses are recorded when they occur, not when cash is received or paid. Types of accounts. Accounts are categorized into three main types. Real accounts related to assets and properties. Rule: debit what comes in, credit what goes out. Example: land, buildings, cash, machinery. Personal accounts related to individuals, firms, and institutions. Rule: debit the receiver, credit the giver. Example: John's A.C., Bank A.C., creditors. Nominal accounts related to income, expenses, gains, and losses. Rule: debit all expenses and losses, credit all incomes and gains. Example: rent expense, interest received, salary paid. Golden rules of accounting. Type of account rule. Real account: debit what comes in, credit what goes out. Personal account: debit the receiver, credit the giver. Nominal account: debit all expenses and losses, credit all incomes and gains. Important financial statements. Journal: the first record of financial transactions. Ledger: a collection of accounts showing transactions in detail. Trial balance: a statement ensuring total debits equal total credits. Profit and loss account shows a business's income and expenses. Balance sheet shows the financial position of a business. Accounting equation. The basic accounting equation is: assets equals liabilities plus owner's equity / text, assets equals / text, liabilities plus / text, owner's equity, assets equals liabilities plus owner's equity. This equation ensures that the books are always balanced. Types of accounting. Financial accounting: recording and reporting financial data. Management accounting: analyzing financial data for decision-making. Cost accounting: identifying the cost of production. Tax accounting: managing taxes and compliance. Thank you for watching video. For more informative videos, please subscribe to our channel.